Yes, guys, welcome to the next video. So in this one, we're going to be looking at ranges and consolidations. So until now, we've pretty much covered the core concepts of the technical strategy that we're going to be using. Of course, we looked at points of interest, different types of order blocks, market structure, liquidity, everything to do with that. So now let's actually understand how we trade in different types of market conditions. So as you know, there's two main types of market conditions. You've got ranges and consolidations, and then you've got expansions and continuations. So why do we actually have consolidations? So the literal reason for that is because there's an equal number and volume of buy and sell orders. So as you can imagine, for every buy order that happens at the time, it's compensated by another sell order of the same amount of volume. So what that means is price is very stable and doesn't move anywhere, doesn't move up or down. Just really, it just really consolidates as seen below. So there's a buildup of liquidity and orders on both sides of the marketplaces. So you can understand when there's a consolidation, you're going to have buy side liquidity, sell side liquidity. There may be times where you have equal highs, equal lows, trend line liquidity as well. And all of this buildup eventually will be swept out. And once liquidity is taken, so all the stop losses from here, all the stop losses from here, price will come eventually to take it out and then expand. And that's just part of the price cycle. The next stage after consolidation is the expansion stage. So how to actually trade in a range. Now, the strategy is to take as many profits as possible and as soon as possible as well, because you've got to understand that when you're in a consolidation, you'll get many, many valid points of interest. As shown here, we started off with this price showing buy side liquidity. As we went down, and a clear order block was shown in the premium area. So when we got to the low, we started buying up again. And then once we got to the premium area, we mitigated this right here, came back down, and then mitigated this order block that was created right there. So what we've started to create is a bit of a retail channel, as you would call it. And that's exactly what consolidation is. The volume is decreasing and decreasing. Because if we saw a step up in volume, then we'd start to see massive spikes to the upside, as we're starting to see here. Now, this is where the consolidation is started to stretch out a bit, and price is actually starting to take some of the liquidity that we've created before. So for example, this price move right here would have taken that buy side liquidity. As soon as that happens, what can we expect? Some sell side happening, of course. The thing is, with ranges and consolidations, there's going to be many areas where you get points of interest, like order blocks or breaker blocks, whatever it may be. But not every single one of them is valid. You would have thought, okay, now that we've got this buy right here, if we were expecting more buys and we had bullish momentum, yes, this order block would have been valid. However, because we're in a consolidation, what that means is that price does not actually respect certain points of interest as if we were trading within an expansion or a continuation trade. And now don't expect massive price movements, but rather expect minute volume. So definitely one thing that I'd recommend is to take profits as soon as you can, but also at strong points of interest. So if, for example, I understood that time of day was correct and everything, that's what we're going to be getting into in the next part of the technical section. But if I took a sell from here, I understood that we were just taking the stop losses from there. If I had taken a sell, my take profit would have been at this order block. Not here, not here. Because the thing you've got to understand is price can reverse at any point, at any order block, really. And that's why it's a bit dangerous to trade in consolidations. And of course, you can trade within consolidations, and I do it myself, but you really need to have a proper understanding of what's going on, where price can go, and when to efficiently take profits. So let's take example in the live markets. So market structure right here, as you can see, is quite difficult to understand. It's just presenting question marks everywhere. So we've got this low, then we've got the lower high, then we've got a higher low, then a lower high again, and then we get the lower low. So at this point right now, we would start to think, okay, now we're downtrending because we're starting to see there's mitigations to the downside, right? That's exactly what happens here. But then when price gets right there, it mitigates this, essentially this breaker block area right here, starts reversing the other way, and then comes back again below that low again. So what we start to understand right here is that we're in a consolidation. So we really need to be careful with the trades we're taking. If you had taken these trades right here, you would have incurred some losses unless you took profits very quickly or even went break even for every single trade. The example that we see here is when we mitigated this area right here. Yes, you would have got the entry in, but it came straight back to take your break even or your stop loss even. Came back down. Okay, so now we've got this clear point of interest right here. But no, again, it shoots straight back through. Now, in conclusion, try to avoid trading any pairs that consistently consolidate, since you will find it's tough to get a clear market structure that you can do well with. Stick to more trending pairs, since this is where you will get the cleanest price action. Some of the best examples of consolidating pairs is Euro GBP and AED NZD, because the two types of, or the four types of markets, in relationship to each other, Euro GBP, AED, NZD, they're very similar to the way they move because their economies may be quite similar in terms of fundamentals, whether it's their trades, their exports. There's various reasons, but we're obviously going to look at that in the fundamental section in more detail. But just to understand this, it's much better to trade expansions and continuations. And when you've got consolidations, reduce risk especially, and do not overtrade, because you will find yourself so frustrated trying to understand some kind of market structure, but consolidations will make it very unclear. And obviously there's a lot more to it that we're going to be looking at in the second and the third section. But yeah, guys, that's it for this lesson. I'll see you in the next video.